you look at bond investors or funds, those who are building a fund on the high yield market, maybe in a specific location, that usually comes with more risk, right? Because if you lend money to a company who is in need of money, and maybe the environment like we're going through now, higher interest rates, maybe a recession, then it will of course come with a lot of risk. And then you can maybe in a couple of years look back and say, who gave the loans out to the companies who survived and managed to get the cash back? Because I don't know, if you hit a recession, a lot of companies will have to default at some point, I guess.
Yeah, but that's up to the investor to decide. You know, there is a lot of greed out there, Chris. And of course, if you're greedy, why would you invest in the US investment grade market that is paying 6% when you can invest in the high yield corporate bond market that is paying you 9% in yield? You know, definitely you want to receive 6% or 9% yearly. I definitely want to receive 9%, but the problem is that to get that 300 basis points pickup, you have really to trust that the house of cards is not going to fall. And
it's also, if you look at that, it's just a horror story always, the US crash with the junk bonds, etc. Or do you think you will see that again in the future in a different structure, etc.?
It's very hard to see what is coming, but we can definitely talk about what we have seen in the past year. And what we have seen, we've seen a banking crisis somehow in the UK during the mini budget crisis in September, because with rising interest rates, a lot of derivative positions triggered margin calls, and a lot of pension funds didn't have the money, the cash, to cover it up. We have seen the SVB crisis in March in the US. So it would be naive to think that nothing else is coming, right? And that's why I go back to what we were, to what I've been saying since the beginning of the call. You know, like, you want to be as conservative as you can. It's true that you might not outperform market. Look at those people that were expecting a crisis last year, and the stock market, the Nasdaq went basically like exploded. but it was unforeseeable, and it's very hard to make those decisions in a rational way. What is rational right now is to understand that we are in an unprecedented kind of interest rate environment. We didn't see this since 2007. In 2007, that was followed by a very deep crisis. If we look at other environments, when the Federal Reserve has hiked, not only Federal Reserve, but also the ECB, we've seen that everything has been followed by some sort of crisis, and definitely this is going to come again. But does that mean that then, because at a certain point in the future, central banks are going to cut rates, which they will? You know, the problem is when, right? Does that mean that I have to go and buy my Austria Centurion bond? Probably not, because we have seen that right now the position of central banks is to put pressure on the economy, and until that is in a place, my appetite to increase duration risk is not strong, but it will become strong, and it will be I tell you, last week it was tempting to enter 10-year US Treasuries at 4.8%. There has been the 30-year US Treasuries at 5%. Amazing levels, not only for speculators, but also for buy and hold pension fund kind of investors that they want to secure, like solid yield, risk-free for the next 30 years. It made absolute sense. The rally this week, a correction after the sell-off we have seen, it's absolutely understandable. My question is, can it last can it last? Obviously, it's helped by what is happening in the Middle East. Yes, it could last, but you know, like I want to see that CPI print going lower, even though there is a war in the Middle East, because war means higher inflation, but also means bigger spending, and bigger spending comes with more bond issuance. So both of them are bearish for bonds.